Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference, and I'm here with Arne Noack, who's Director of ETF Passive Management at Deutsche Asset Wealth Management. Arne, it's great to see you, and thanks so much for being with us today.
Thank you for having me, Tom.
You folks have done a tremendous job of accumulating assets in your Deutsche Bank X-Trackers products. I mean, they've just done a tremendous job focusing on currency strategy. So give us the basics, give us a one-on-one on currencies and why these strategies might be working today.
Absolutely, with great pleasure. So as an international house, as a global international house, we have a great emphasis on how to make international investment more efficient than it currently has been. So as part of that strive, we've developed a very significant range of currency hedged equity products. Those include, for example, tickers such as DBEF or DBU that allow international investments into the European or international equity markets without necessarily having to bear the currency risk that is usually associated with these international investments. So of course, in an environment that we've seen recently where the dollar has appreciated significantly over, for example, the yen or the euro, these products have gained fantastic tractions, that they've had great performance, and therefore we've been in the headline of late, which is very nice.
Absolutely. And do you, as you look forward, and you have got a lot of economists on board, do you feel that we're going to continue to see the dollar appreciate compared to other foreign currencies?
So there's two aspects, I would say, to the currency-specific story. Our house in particular is, together with a couple of other major houses on the street, very bullish on the US dollar, and for example see it at parity to the euro at some point in 2016. So yes, there's certainly an element of bullish dollar to that story. However, something that we've discovered is that not only necessarily is this a bullish dollar story, but it's much more a strategic story whereby reducing currency exposure helps reduce overall risk in the portfolio simply by reducing risk coming from a currency exposure. And that overall can help limit volatility. So we have two angles in terms of describing our products, one a risk aspect and one a return aspect.
So from a strategy standpoint, for the average advisor who may have global positions, there's an opportunity to reduce the currency risk, even if you go currency neutral, by diversifying not only with the current positions that they have that don't do that, and with your ETF allocations that do. Is that right?
Absolutely, that's very precise. There's no need to substitute one for one. There's what we would advertise is to carefully analyze the positions that currently exist within a portfolio, not only from a country allocation perspective or sector allocation perspective, but also from a currency allocation perspective. This has usually been an aspect that largely has been neglected, and once you hone in on what is actually my currency risk, you can then make a conscious decision over whether this is a risk that you're comfortable taking, whether this is a risk that you're actively taking, or whether you don't have a view on that currency and therefore hedge it out with the help of our products.
Currency really is an asset class, but it really wasn't available easily for the average investor and the average advisor. It is today, and is that a tool that advisors have to continue to focus on as we go forward?
Absolutely. With the evolution of the ETF industry, we're all about providing efficient tools, and we won't stop innovating. You will continuously see innovation, and it is on us to very clearly explain how these innovations will work in advisors' portfolios and how our products that we have come up, will come up, and are coming up can help in an advisor context, in a portfolio context.
The DBX trackers have just done amazing, from as little as $1 billion just a few years ago to now topping $20 billion. Do you think you're still in the early innings? Because these strategies, if that trend continues, even 20 billion might be a big number, but it might just be a drop in the bucket.
Thank you very much for the kudos. We're certainly very proud of our development, and we believe that this is merely a reflection of the quality of product that we have on the range. And yes, we're here to stay. That's simply as it is. We believe we're a force to be reckoned with. We have a number 2 ETF provider in Europe. We're globally number 5. Here in the US, we're in early stages. So we're now ramping up significantly our operations here. We're ramping up significantly our product build out here, the ancillary service offerings here. And yes, we're here to really help the US ETF market develop in areas where we see a need.
Great. Arne, thanks so much for your time. I appreciate it.
Thank you so much.